Welcome to Traders Corner. As always, I'm joined by Garth McKenzie, founder and editor of Traders Corner. Garth, welcome.
Hi, Julieta.
Garth, you're starting off your trading this year with a bang and not a whimper. Two trades that we're going to get through this evening. And I know you'd like to kick off with a look at the big picture, which we did bring to viewers last week. I think we might have depressed them all with our very bearish charts, but I know you want to start off with the S&P 500 tonight.
Yes, that's right. We're looking at the S&P 500 and just looking at the bigger picture to kind of lay the land for where we're going with this week's show. Yes, last week we looked at all the international markets and I showed all the patterns there, and the picture, generally speaking, does look rather bearish, and I still stand by that. But what we've also got to remember is that in bear markets, market doesn't just go down in a straight line. It goes down and then it can rally quite hard. And in fact, in my experience, some of the most violent rallies that you've ever seen in markets often happen during bear markets. And that's because you get a violent short covering that can take the market quite aggressively higher. So, you know, as things sit right now, I feel we are pretty oversold on our market and on global markets at the moment. And I suspect we're entering one of these periods now where we probably will get a bear market rally, and then later down the line we might, you know, take a look on the short side more and look for some opportunities to take advantage of a deeper sell-off later in the year. But for now, let's have a look at this S&P 500 chart, which is what we showed last week. And again, I'm showing it here. This chart goes back about 2.5 years or so. And what's very clear on this chart is that there's a big head and shoulders pattern which has been forming for the last 2 years. And you can see it on the graph there. Your neckline for that head and shoulders pattern comes in around about 1880 on the S&P 500. And what we have begun to notice this week is that there appears to be some buying interest happening at about 1880. The market does look as if it's reversing up off of that support level. It's extremely oversold at the moment. I mean, for January, it's really just gone down and down and down and down. There's been no up days to speak of really in January. So it does look as if we're in a situation now where this S&P 500 is beginning to find some support. It's a likely area where we would probably see a bit of a bounce happening. And with that being the case, I think that could lay the backdrop for a bit of a bounce in other global markets, including our market as well.
And especially, I suppose, I mean, there's a few factors to consider, but today we're having a pretty good day in the market. It seems to be related to the Chinese numbers out, which I mean, the market seems to be choosing to react well to them because it could just as well react badly.
Yes. Well, the Chinese GDP figures came out at 6.8% growth, and the expectation was for 6.9%. So obviously that's a slight miss on the growth numbers. But the way the market is interpreting that is saying that, well, then it therefore increases the likelihood that the Chinese authorities may step in and apply some more stimulus to the economy, and therefore that is good news for markets in the short term anyway. So the market has rebounded quite nicely today on the back of that, and that kind of puts us in line for what we're doing today. But before we get there, I want to show a graph of our top 40 index, which also looks back over the last 2 and a bit years, like we did with the S&P 500. And what's evident on this graph is that there's this big band of support between 41,500 and 42,000 on the top 40 spot index. And that area certainly, you can see it's a big band of lateral support there. All the lows that we've seen since early 2014 seem to have found support in that area over there. And it does appear as if our market's reversing up off of that zone today. And I'll show you more of that on the top 40 future graph. But again, we are very, very oversold on our market, like the S&P 500 is. And this does potentially lay the ground for a little bit of a bounce from here. And my feeling is that we'll bounce now, but we're probably not going back to our highs. We're probably going to stop short of the highs somewhere and then falter and come back down. And eventually later this year, I wouldn't be at all surprised if we saw that 41,500 lateral support area breaking to the downside. But I don't think that's going to happen just yet. I think that's still a while away.
So Garth, if you're going to hone in on a chart of the top 40 future, then what does that look like? Yeah,
so here it is. This is now an hourly graph of the top 40 future. So what that means is that every candlestick pattern that you see on this graph represents 1 hour worth of trade. Now this graph goes back to the end of December, and the downtrend that we've got on this graph basically started on the 28th of December last year, and you can see that throughout January we've basically been sliding. But you know, and there are a couple of points to talk about here. First of all, we've got all these open gaps on the top 40 future. Now a gap like that happens because our market is only open for 8 hours of the day, or the futures market's open for 9 hours a day. But then it means we closed for the remaining 23 hours. And not 23. I'm struggling with my maths. 15 hours, whatever it is.
I was going to say, it's a long day there at the office at Traders Corner HQ.
Yeah, clearly we work long hours, yeah. So the market's open the futures are open for 9 hours and closed for 15 hours. And what happens in the morning after that is that our market then needs to adjust for whatever's happened overnight.
Yeah.
And that's where you get these gaps. And we've seen three rather large gaps down on our market over the last, during the course of January. But what's interesting to note today is that we've had, for the first time, a gap up, and this gap hasn't been filled. And this, for me, is always an encouraging sign. When you get a gap like that, particularly when it happens at a break of trend, which is also what we're seeing now, you get that gap higher, the gap doesn't get closed, and that is an early indication that you're likely to see follow-through buying on that gap. What's also quite evident on the top 40 future graph here is that there's been positive divergence on the RSI, the relative strength index, meaning that we've got a sort of a crude double bottom on the futures contract itself here, but the RSI has made a slightly higher low than what it did on the previous leg to the downside. And then stacked also with that, we've got a break of this downtrend which started on the 28th of December. And that break of the downtrend is bullish, and it potentially puts us in line to move. I think we could probably feasibly see a 2,000-point rally in the market here. And what I've put on there in the graph now are the Fibonacci retracement levels. And what often occurs is you get a bounce into the 50% to 61.8% retracement area. That would imply that we could see a bounce to around about 45,000 to maybe 45,500 on the top 40 future. And that's what I'd be looking for here.
Well, I mean, 2,000 points, at one stage we'd made half of that today.
Yeah.
We were up just over 1,000 points up. So.
Yeah, that's it. So we're looking good so far. I've gone and done this trade this morning. I bought one MAR16ALSI future at 43,000.
Okay.
Now keep in mind that every point on this future represents 10 Rand per point. So I've done that. I've got a stop loss of 42,400. Which is sort of yesterday's lows. If we break below there, then I wouldn't want to be long. But as things stand right now, it actually looks quite good. We're breaking the downtrend. The market's holding on to its gains into the end of today's session. It looks like we've got further bouncing to come here.
Okay, so take us through in greater mechanics the detail of that trade.
All right, so I've gone long one MAR16ALSI at 43,000. Keep in mind that this is 10 Rand per point, so there's therefore 430,000 Rand worth of market exposure that I've taken here. My stop loss is at 42,400, so that means my risk is 600 points. Given that each point represents 10 Rand per point, that means my risk is 6,000 Rand here. And that equates to about 2.4% of capital. So
a little bit higher than what you would normally take. I mean, that is a bit more risk that you're taking there.
It is. Normally, we don't risk more than 2% of our capital on a trade. This is really just a function of the fact that the contract size is big. One top 40 future is 430,000 Rand exposure. I've done it using that product. I
mean, Garth, in the past you actually have used the micro contracts that IG provides.
Yes.
You didn't consider that? Was there any particular reason?
I did consider it. I think it's just I was trading on the futures this morning, and I decided to hang on to this one futures contract because it actually worked for us. And like
straight
I often said, that the trade worked straight off the bat. So I thought, okay, that's a good sign. So I'll hang on to this. It is a slightly bigger risk than what we ordinarily take, but not massively so. 2.4% versus 2% is not a big deal, really.
Yeah. Okay, so that's the first trade.
Yeah. Well, I'm looking for 45,000 here, which is 2,000 points upside, and that would imply a risk to reward ratio of 1 to 3.
Okay, which is pretty much it would be in the sweet spot if it hits that.
Sure.
Garth, so you've gone long of the market, but short an individual share, and
yes.
it's an interesting stock that you've picked. It's Cashbuild, and it's a stock that has been a darling. Well, it certainly was last year, and it seemed to kind of weather really bad trading conditions, and it actually came up with a pretty positive sales update recently. So why are you going short this one?
Yes, the reason I'm going short is mostly technical and partially fundamental. You're right that the company came up with good numbers, 15% growth last week, which is good. But what we've got to remember is that is backwards looking. That's last year's numbers. Now, you have to have been living in a cave to not know that South Africa is facing a very, very, very difficult year ahead now in 2016. Our economy is not going to grow very much at all. And being that being the case, Cashbuild is very much in that zone where it depends on South Africa's GDP growth effectively for its profitability. And I think Given the technical breakdown here that we're seeing on the stock, and also given that economic outlook, my sense is that we've probably seen the best for this share price for now, and there's likely to be downside. So if we look at that graph, you're right that it's had a good rally. Over the last year or 18 months, the share price has basically doubled from its recent lows to its recent highs. But now what I've noticed is we've had this fairly significant breakdown below lateral support. That lateral support comes in at 290 Rand per share, and the share price has broken down below that level. It's now rallied back up, and that rally actually occurred on that sales update. The share price rallied back up to test the underside of 290 Rand. What usually happens in a situation like this is that previous support now becomes resistance on a retest. And what it implies also is that you've now got effectively 7 months worth of overhead supply and stale bulls holding the stock, which are now probably going to be getting a bit iffy, a bit cautious, a bit nervous, and they would be inclined to want to sell into any rally, I believe. So technically speaking, that breakdown below 290 Rand opens a technical target of 230 Rand to the downside.
Okay.
So that's quite a big downside target. So on the basis of that, on that technical break, on the basis of the fundamental outlook, I've gone short when the share price bounced back up to that resistance. I've gone short at 290 Rand and 45 cents. And this is going to be a medium-term hold. I'll be in this trade for quite a while, I suspect. But we're looking to run it down to 230 Rand.
Okay, so in greater detail there, and also where your stop loss is, because that's quite interesting too.
Yeah, the stop loss is wide. So I've gone short at 290 Rand and 45 cents. My stop loss is 320 Rand, which is a very wide stop loss. I mean, that's more than 10% away.
I mean, you could drive a few Cashbuild delivery trucks through that.
You
Is there any
certainly
particular reason?
Yeah, the reason is twofold. One, that I want to hold this short position for the medium term, and the second is that it can be quite illiquid, this stock.
Okay.
So I don't want to get taken out by an unnecessary spike to the upside. So it's a very wide stop loss, but I'm quite happy to trade it this way. My risk per share, therefore, is 29 Rand 55 per share. I'm going to risk 1.5% of our capital on this trade. So we've got 250,000 Rand at our disposal. That means 1.5% of that is 3,750 Rand, which I'd be willing to lose on this trade. So I take that capital risk of 3,750 and I divide it by the risk per share of 29 Rand 45, and that gives me 127 shares. So rounding that up to 130 CFDs for our portfolio.
And the risk to reward ratio?
Yeah, so if the target's 230 Rand, then what it means is that the risk to reward ratio is 1 to 2. And you might say, gee, that's a long time to wait for a 1 to 2 risk reward trade to pay off. But you know what, if we get plus 3% on our portfolio in a market that's falling, well, that's good absolute return. And I suspect I'm going to be trading the market more like this over the course of the year, looking for shorts that I can actually run for an extended period of time.
With wider stop losses,
Yeah.
so you don't get stopped out, which I have to say, the caveat being, it's something that as a day trader, if you're sitting at your desk and looking at your screen, this is something that will work, but not necessarily if you're away from the market and you've got these automatic stop losses.
Yeah, exactly. And that's why putting the stop loss nice and wide should allow us to actually overcome the volatility to some extent.
Okay, Garth, so what does the portfolio look like given the 2 trades at the moment?
All right, so we long one contract of the top 40, which I mentioned. At the time that I put these slides together, we were up 1,250 Rand on that. It's more now because the market's been strong this afternoon. And then the Cashbuild short, we short 130 CFDs there, and there we also with a profit of about 1,700 Rand. So net, we're sitting on 253,000 Rand, so we're up about 3 grand for the year to date, which is up 1.2%. So it's a positive start, and long may that continue.
Yeah, and then just to end off, Garth, your next courses.
Yeah, I've got 2 courses coming up in Johannesburg on the 30th of January and in Cape Town on the 6th of February. These are high probability trading courses. And note that I'm going to be focusing specifically on bear market trading strategies on this course. My high probability course has been running for about 3 years now, and we've typically focused on the bullish side of the market because it's been a bull market. Yeah. But now that we're in a bear market, I want to focus on bear market trading strategies. So anybody interested in attending these courses, please email me on garth@traderscorner.co.za and I'll send you all the information.
Great. Garth, we'll see you next week. Thanks as always for joining us. Garth is, of course, the founder and editor of Traders Corner.